Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back. We didn't have a video alert last night because we only had one trade that closed out. So I wanted to go over that trade as well as the other ones that we had traded today on the 24th of April here. But before I begin with those trades, let's go over that one trade that was on for yesterday, and that was just one closing alert for eBay. And you'll see that 423, I just designated it here inside the membership area. But we had closed out our short put spread in eBay, and it was really nothing more in eBay than the stock rallying, which obviously helped. We had the 52.5 50 short credit put spread in eBay. We sold it for about 90 cents and bought them back yesterday for a 45-cent debit, so right at our 50% of max potential gain target that we usually have for those credit spreads. So again, with credit spreads, which is different than debit spreads, we're targeting about 50 to 75% of max potential gain. Now, eBay has earnings coming up on the horizon, and here's a chart of eBay. And you'll see that really it was much more of the stock rallying, which really helped, right? So the stock rallied upwards, which helped our credit spread. And we did see a little bit of a drop in implied volatility, which obviously helped our position as well. So as the stock gets closer to earnings, we've already started to see that decay in volatility, which again just really helped accelerate the profit in this position. Moving on to some of the other closing trades, before we get into talking about XOP, which is a little bit different type of strategy, we had a nice trade in Apple today, which really helped out in overall for May and June expiration. So this was the vertical call spread that we had in Apple. We were long the 520, 530 vertical call spread in Apple. We bought it for around 487 or so, and sold it back to the market for an 852 credit. Now, if you look at the difference in the strikes, there's about a $10 wide strike. So what that means is that the most we could sell this back to the market for, which would be practically at expiration or all the way out in June, would be a total credit of $10, right? So that would be the theoretical max we could sell this thing back for and profit about $500. Well, we have a June option, so it's not going to get there anytime soon. And in fact, I think the highest this thing was trading today was around 9:30 or so, and I tried to fill it around 9:30 and just really couldn't get any fills on either the ICE or CBOE or anything like that. So it really wasn't filling up at those prices, even though they were theoretically trading. And I know a lot of people email me about that, but we got out at 820 at 852 today, which is a really good price. And again, for a original 50-50 bet in Apple, this was a huge move after earnings, which is really kind of the whole driver in this Apple play, is just that the stock had great earnings and popped up after the open here in the morning. Qualcomm is another one. I don't know. I believe this one also had earnings and kind of gapped down. I actually have to check the chart. I have no idea. I just saw that it was decaying in value and closed this one out today. But this is another one that we were short a 825 call spread. So we were actually short this call spread. Therefore, we bought it back, though we added back those two verticals that we were short and bought each of those back for 25 cents in debit. Again, these are May options, so they're not going to decay much further than this, where it's just not worth the risk to hold them all the way till May for another 25 cents. We've already made $55 in profit per vertical that we bought back. So it was a nice over $100 trade here. I'm not going to let this trade hold on for another $50 all the way through May expiration. If we actually go to the chart here and just take a look at Qualcomm. Oh, here we go. Yeah, you can see that I thought it had earnings. So you can see that the stock had earnings. So they reported, I believe, last night after the close and gapped lower, which obviously, again, just really helped our position overall. Notice how quickly implied volatility dropped, right? We already had a credit spread on the call side, so we would have never entered that credit spread unless IV was above the 50th percentile, and I think it was in the 60th percentile or so in Qualcomm when we entered this. So the fact that implied volatility in just one day has dropped so dramatically, it's down now to the 18th percentile. So you can see how much of an impact earnings has on implied volatility for options, and really it becomes just a huge factor in people making money. I mean, I know that a lot of people tend to buy options around earnings because they're expecting a big move in the underlying stock, and how wrong they are that they get that move in the underlying stock, but they don't factor in implied volatility, which just crushes the potential of that move. So if someone had bought a put and expected a huge move in Qualcomm lower and then got that move lower like we did today, they might have actually lost money because of the drop just purely in implied volatility. So remember that even though you get the big move in with options trading, it's not only about the move, but about the timing of the move and the magnitude or implied volatility that happens afterwards. So huge lesson here. And again, we just want to take profits off the table. Okay, so let's spend a little bit of time on the opening trade here tonight, and then I want to talk about one other thing, which is the BX trade, where some of us got assigned a short option, so I do want to talk about that at the end of this video, so I will not forget that one either. But let's spend a little bit of time on this opening trade that we had sent out, and it was on XOP, and we've actually had fairly decent success trading XOP with some butterflies and condors and credit spreads, etc. throughout the last couple months. And what we did is we went in here and bought a broken wing butterfly. So you'll notice again, and we've done a couple of these videos now with these broken wing butterflies, but the strikes are not evenly spaced apart. So in this case, we went in and we sold the 78s. I'm sorry, we bought the 78s, sold the 79s, which is just $1 away, and then skipped over the 80s and bought the 81. So you can see that's our broken wing. This is that side. It's on the kind of the right side of the profit loss diagram that we have this broken wing. And what that does is by allowing us to go out to the 81 strike instead of the 80 strike, we pay a little bit less for that extra protection on the other side of the butterfly. And that allows us to then actually buy the spread at a credit. So it kind of sounds like an oxymoron, right? We're actually buying, and we usually buy for a debit, and if we sell, we sell for a credit. But in this case, we're actually buying because we're a net buyer of options, but we're actually buying for a credit. So at the end of the day, after adding up all the sells and credits and all that stuff with all the strikes, we actually end up getting a credit of 30 cents. So what does this mean on our profit loss diagram? So here's what I want to talk about with XOP. So here is the profit loss diagram for XOP, and I think this is really going to help, and I know I've gone through this before a number of times. So this is the profit loss diagram, and it's in red of XOP. Notice down below which options we are long and which options we are short. So you'll see that our long options were long 2 of the 78s. We are short double that, so 4 of the 79 calls. And then by skipping over the 80s and being long the 81s, we paid a less price for those, which allowed us to get a credit overall. So by doing that, we're got a credit of about 30 cents per spread, so about $60 overall. Now, on the profit loss line, you'll notice that this is what our broken wing butterfly looks like. And forgive my cursor here and highlighter because it's not exact, but you can see where it's kind of following and kind of outlining. But you see this broken wing on this side. So it's not even butterfly. It has this broken wing, and that's because we skipped over the 80 strike. Had we done the 80 strike, it would have looked something like this, kind of like a dotted line. It would have been very even and symmetrical around 79. But by skipping over 80, we actually bring our break-even price out to just past 80. So you can see that our break-even price is just past 80 or so. It's about 80.30 or so. And what that means is that that's really kind of the line in the sand for the stock going forward. So the stock is actually trading, or the ETF is actually trading at 77.94 right now, which is kind of around here. And so what this means is that we actually do want the stock to rally just a little bit by expiration, but really not past 79. So we make most of the money at 79, which is this short strike. That's obviously where we make most of our money. And it can actually rally past that a little bit further, but we don't want it to. Now, if it does rally past that, we obviously don't want to go past our break even, but we are protected on the downside. So we have this downside protection, which is why we bought those 81 calls. Now, on the other side, if the stock were to go down, which is really what we're betting on a downward move, and I'll show you the chart here in a second. But if the stock goes anywhere lower than 79 or 78, then we actually keep that entire credit that we had bought the spread for. So by buying the spread for a credit and by doing it this way, we actually only have risk to one side of the butterfly, which is a little bit different than your typical butterfly setup. So your typical butterfly setup actually has risk on both sides, and you kind of want the market to stay neutral. Well, in this case, neutral is good and slightly higher is even better. But if the stock or ETF actually crashes, then that's okay too, because we just keep the credit and everything expires. So if we actually go to the chart here, you'll see what I'm talking about here with XOP. Now, you'll notice that the reason that we sold or bought the broken wing butterfly on the call side is because of this huge rally that the stock has had just generally over the last couple of months and weeks. So we think that at some point it's due for a move lower. And so that's what we're playing on. We're playing on a move lower. Ideally, we'd like to actually just keep the credit. We like the stock to, or the ETF to fall, and we just keep the entire credit that we received. We don't have to buy anything back, saves us a lot of commissions, etc. But if the stock actually rallies up a little bit to around 79, we're okay with that too. So we've got a little bit of room on the top side as well. So a little bit different trade, a little bit unique of a setup, but again, really powerful when you know how to set these things up right. You can kind of really maximize your risk and reward potential here. Okay, so let's talk about one more thing, and that is BX, and this is Blackstone Group. So we had originally sold in Blackstone Group, and let me go to the Analyze tab so you guys can see this. We had originally sold the 3130 call spread in Blackstone. So you'll notice that I got assigned today the 30 calls. So now I am short 500 shares because I was short 5 contracts of the 30 calls. So I'm short 500 shares of stock at a price of 30. Now, while everyone is freaking out about this, again, this is why you keep your position size small, and this is why you trade mostly spreads and iron condors and things like this, because this actually isn't a bad thing. It's not like we're just total short stock now and we have all this unlimited exposure, etc., etc. We still have a long call that we have not exercised. Now, I could have exercised this immediately, close out the entire position, and we would have taken the difference in the price of the security, right? After all is said and done. But here's what we're doing, at least at this point. The stock is still a little bit top heavy, and we still remain bearish on the stock. So by having this long call right here at 31, and by being short the stock of 500, we are actually basically trading a synthetic long put option with a strike price of 31. So it's a little bit different, and you have to visualize it on the chart, which really helps make it kind of stick out. But you'll see that it basically looks like we've just gone in and bought a put option at a strike price of 31. So by being short the stock at 30, long calls at 31 as kind of protection against the short stock, we basically are in a synthetic long option, put option at 31. So actually today we made about $200 on the trade because we didn't do anything. So by not exercising and getting too jumpy and kind of jumping the gun, we actually made money on this exercise that someone had put on to a lot of people. Not everyone got exercised, but a lot of people got their options exercised today. And even though that happened, the stock was actually down today, was actually down almost 0.5%. And so that really helped because we were basically long a put option at a strike price of around 31. So you'll see that we still have a lot of time between now and expiration. We still have very limited risk to the upside. So if the stock just continues to rally, our short shares will lose money, but our long call will make money and kind of negate that rally out. So at this point, we really just have kind of exposure to the top side a little bit, but it's limited. So we have unlimited potential to the bottom side by trading a synthetic long put at 31. So ideally, we'd actually just like the stock to drop about another $1 or so, and we'd actually make a pretty decent profit on this thing overall. So that's what we're doing here. And usually what I do with these, if I actually get exercised this early in the cycle, which is kind of rare, but I know it happens because of some dividends that are happening, then what we do is just kind of play this out and see if our underlying core logic for the stock still remains. So if we're still bearish, I'm still going to hold this position. If things had changed and now we become bullish, then I might look at exercising my long calls and just canceling out the short stock that I already have by getting some long stocks. So at least at this point, we're just going to hold this position. For those of you who have this position and are assigned the stock just like we were, feel free to do whatever you want with this position. If you don't feel comfortable holding it at this point, go ahead and exercise your long option. It will cancel out all of the short stock by being long 500 shares, so you'll be totally out of the position with a loss in the difference of the strikes. But at least at this point, we're long a synthetic put option and we have limited risk to the downside. So we're going to try to play this thing out for a couple more days and see what happens and try to play the market. This is the beauty of keeping your position size small, because now we have the ability to be a little bit more flexible in what we do going forward. So as always, I hope you guys really enjoy these videos. I know it was a little bit longer tonight, but I wanted to get to a couple things here and I thought that it was really important. If you have any questions or comments, please add them below here, and happy trading.